Today on Real Estate Backstage, NAR overturns its no-commingling rule. Redfin shareholders voted to approve the $1.7 billion acquisition from Rocket. International demand for U.S. real estate jumps. And finally, an out-of-the-box solution that just might be the answer to the mortgage lock-in effect. Before we jump into the conversation today, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, go ahead and subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes with links to all the articles that we covered today, you can find that at realestatebackstage.com/episode 31. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. So we're going to kick things off today with a story from Inman. Quote, leadership from the National Association of Realtors on Wednesday voted to scrap a controversial policy that separated listings depending on whether they came from multiple listing services or non-MLS sources. The policy was known as the no-commingling rule. It was an optional policy that allowed MLSs to prohibit brokers from displaying listings from MLSs together with those from non-MLS sources. On Tuesday at NAR's legislative meetings gathering, the trade organization's Multiple Listing Issues and Policies Committee voted to rescind the policy. The decision to ditch the policy or not then moved on to NAR's executive committee, which voted Wednesday to abandon the rule, according to a statement from NAR. The National Association of Realtors Executive Committee repealed the optional no-commingling rule from the MLS policy handbook, the statement noted. This decision was based on feedback about the rule's declining usage and relevance in local marketplaces. The no-commingling policy has in recent years become a source of controversy for NAR. That controversy sprang in part from an antitrust lawsuit that now-defunct brokerage Rex filed against both Zillow and NAR. Rex eventually lost that legal battle, and legal filings in the case show that 29% of realtor-affiliated MLSs have chosen not to adopt the rule, unquote. So this no-commingling policy, it was optional, but about 70% of the NAR-affiliated MLSs across the country did choose to implement it. And that's why when consumers were on websites like Zillow, they had to actually toggle back and forth between lists of properties that were listed on a NAR-affiliated MLS versus properties that were listed by companies, brokerages that weren't a member of NAR and for sale by owners, different things like that. So now that this rule has been scrapped completely, we're going to start to see Zillow and other search portals commingle all of these various listings together. That is going to provide, in my opinion, a better experience for the customer. And we've talked about this on the show before. I think if you just streamline things and make it easier for the customer, that is going to lead to a better experience overall. Well, speaking of NAR, the new CEO is definitely bringing a different type of energy than what we're used to from prior leadership. This is according to RIS Media. Quote, the National Association of Realtors legislative meetings kicked off in earnest on Sunday, June 1st, as CEO Nikia Wright and members of a revamped leadership team took the stage in front of around 2,000 NAR members, all seeking signs that the organization's promised turnaround will deliver real change. A year ago, in the same building, when NAR was reeling from a historic court loss and subsequent settlement agreement that some feared would prove a death knell for the industry, rank-and-file members brooded as NAR kept itself insulated and stuck to its talking points with the legal battles still raging. The contrast could not have been greater this year, as a packed auditorium got a sharp, straightforward talk from Wright and several new faces on her team who offered substantial updates on key issues and acknowledged in plain language challenges both in the past and in the future. NAR may need to pull out another $32 million from the budget next year based on shrinking realtor dues and other economic headwinds, she said, with realtor membership projected to fall to 1.2 million. That's down almost 25% from pandemic-era heights. NAR also has another $72 million payment of its $450 million settlement, which is coming due in February of 2026, Wright noted. Sears also pointed out that on the positive side, NAR balanced its budget for the first time in a decade last year, requiring about $20 million in cuts, he revealed. Sears also quickly dispelled any fear that dues would be raised next year, saying that instead, NAR would be asking directors to carve out around $10 from the $45 consumer ad campaign special assessment to bolster the budget. Wright also promised more accountability and transparency regarding how NAR spends their money without providing further details, saying NAR had received significant feedback around those issues as part of an extensive outreach campaign, unquote. So NAR leadership is trying really hard to right the ship here, and I certainly hope that they can pull it off. I think it's really important to have strong leadership, to have a strong association at the national level, Now, the last several years, NAR has been plagued with scandal after scandal, and the most recent couple examples of those have been financial related. And NAR has a lot of hard work to do to earn back the trust of its members. But like I said, I think it's important to have a strong NAR to really push forward those advocacy items that are important to us and to homeownership in general. All right, shifting gears, let's talk about how the DOJ's priorities have changed since Trump took office. This is according to RIS Media. Quote, as expected, or at least hoped for, the Department of Justice under President Donald Trump appears to be approaching real estate-related enforcement actions very differently than it did under former President Joe Biden or even under Trump's first term. According to NAR Executive Vice President and Chief Advocacy Officer Shannon McGann, speaking to the Business Issues Policy Committee as part of NAR's legislative meetings, the DOJ is pleasantly shifting the focus of their inquiries. The Trump administration's priorities the last go-around were more focused on fees, McGann said. The current administration is much more focused on the technology industry. According to McGann, the antitrust division at the DOJ is seemingly pivoting to look at regulations or state laws that are impacting the cost of housing, following public statements and executive orders from Trump, which have broadly blamed overregulation as a significant contributor to housing affordability, or unaffordability rather. NAR has a seat at the table as part of that discussion, she said. McGann added that the Assistant Attorney General, Gail Slater, who oversees the antitrust division, quote, is someone I've known for years. We do know many of the staff who are over there, and we're again pleased to see they requested information on regulatory burden, McGann said. McGann did not say whether or not the DOJ has dropped or made any significant changes to its long-running investigation into NAR practices, which began and was initially concluded under the first Trump administration, but then revived under Biden. McGann's comments come as the DOJ has indicated in other places it is shifting its focus as far as NAR and real estate policy, something that McGann noted in her discussion. In the long-running MLS Penn Commission case, the Antitrust Division recently dropped its opposition to a settlement agreement after the parties shifted their deal to mirror the recent NAR changes, specifically banning commission offers from the MLS, unquote. So I think it's a little bit too early in the new administration to know exactly what the DOJ's posture is going to be towards NAR and the real estate industry in general. Certainly, they've dropped some cases. They've made some changes. You know, anytime a new administration comes into power, the agencies always shift priorities a little bit to align with the president's vision. But I don't think that we should just assume the DOJ is going to drop its investigation into NAR and let us go about our business. All right, so in other news, Redfin shareholders have approved the Rocket acquisition. This is according to Inman. Quote, Redfin shareholders on Wednesday signed off on the company's agreement to be acquired by mortgage lending giant Rocket Companies, clearing the way for the deal to close this month. The $1.75 billion merger agreement was approved by Redfin shareholders at a special meeting Wednesday, according to preliminary voting results. The window for antitrust regulators to weigh in with questions or objections to the deal closed on May 8th. In reporting first quarter earnings, Rocket executives said they expected to close on the deal as soon as this quarter, which ends on June 30th. 5 Senate Democrats on Wednesday condemned Rocket's plans to acquire Redfin and Mr. Cooper and asked why antitrust regulators at the Department of Justice and Federal Trade Commission declined to challenge the Redfin merger. At a time when families already face a housing affordability crisis, these deals would combine the second largest mortgage originator, the largest mortgage servicer, and the third most visited real estate brokerage website in the United States into a massive, vertically integrated conglomerate that may reduce choice and raise prices for American families in the housing market. Senate Democrats, including Elizabeth Warren, Bernie Sanders, and Cory Booker, wrote to regulators. Instead of competing for new customers by offering better products and services, Rocket's proposed acquisition of Redfin and Mr. Cooper create the potential for Rocket to steer homebuyers to its own products, hike prices based on private data, and block competition, unquote. So there were at least 4 separate lawsuits filed by various Redfin shareholders attempting to block this acquisition. The claim was that it was being rushed and that they weren't being given all of the information necessary for them to make an informed decision. There are also talks of conflicts of interest with Goldman Sachs, for example, which advised on the deal. But the shareholders did vote in the special meeting to approve it, so it's looking like that is going to close by the end of this month. Well, meanwhile, Opendoor is at risk of being delisted from the NASDAQ stock exchange. This is according to Real Estate News. Quote, in a May 30th SEC filing, Opendoor disclosed it had received a warning from NASDAQ after its share price failed to cross the $1 mark for 30 consecutive business days. Companies that cannot maintain a minimum share price of $1 risk being delisted from the exchange. Opendoor shares have closed below the minimum since mid-April and sat at 65 cents at the end of trading on May 30th. Opendoor isn't the first iBuyer to find itself in this position. OfferPad received a similar warning from the New York Stock Exchange in November of 2022, opting to implement a reverse stock split in the following June to remedy the problem. Recently, however, OfferPad stock has dipped back below $1. Both Opendoor and OfferPad launched their iBuyer businesses in the mid-2010s, and other major companies, including Zillow and Redfin, followed their lead a few years later after the model proved successful. But the algorithms didn't account for a sudden market shift like the one seen in the early 2020s, and losses began to mount, prompting Zillow and Redfin to shutter their iBuyer divisions. But Opendoor and OfferPad have tried to stay afloat. There have been some bright spots for Opendoor. After suffering a massive $1.4 billion loss in 2022, the company returned to profitability in 2023 under the leadership of Carrie Wheeler, who replaced co-founder and CEO Eric Wu in late 2022. While Opendoor soon slipped back into the red, it was able to stem losses. In 2024, Wheeler expressed confidence that the company would benefit from the industry changes coming out of NAR's commission settlement, and investors seemed to agree. The company stock jumped 9.5% when industry policy changes took effect in August. For much of 2025, however, it has been a downward trajectory. During the company's most recent earnings call, Wheeler said she believed Opendoor's new focus on partnerships will be a key part of its strategy going forward and a path toward profitability, unquote. So I don't know about you guys. I tend to get Opendoor and OfferPad mixed up. I think the names are just too similar. But Opendoor is really leaning into the strategy of real estate agent partnerships. So if you have a seller client and you're helping them evaluate all of their options, whether to list it on the MLS and get full market exposure, or possibly sell to an iBuyer, you can refer the seller to Opendoor or solicit an Opendoor offer on behalf of your seller, and they will pay some commission for you. Now, we're not going to talk specifics of commission on the show because I don't want to get sued for antitrust violations. Full disclosure, at Bluefield Realty Group, we do fully comply with the terms of the NAR settlement. All right, in other news, international demand for U.S. housing has jumped. This is according to Housing Wire. Quote, international demand for U.S. real estate ticked up in the first quarter of 2025, with foreign home shoppers increasingly turning their attention to southern markets, particularly in Florida and Texas, according to a new report from Realtor.com. Miami ranked as the most viewed U.S. city among international buyers, accounting for 8.7% of all foreign search traffic. Other high-ranking cities included New York, Los Angeles, Orlando, and Dallas. Overall, international home shoppers made up 1.9% of Realtor.com traffic in the first quarter. That's up from 1.7% during the same period of 2024 and 1.3% in early 2020, just before the start of the COVID-19 pandemic. Canada remains the top source of international interest in U.S. real estate, but the Canadian share of foreign traffic at Realtor.com dropped notably from 40.7% in Q1 of 2024 down to 34.7% in Q1 of this year, a decline that coincided with the imposition of U.S. tariffs on Canadian goods and heightened diplomatic tensions, unquote. All right, this next one here is also from Housing Wire. This is probably the most interesting thing that I read this week. Quote, the U.S. mortgage system is a global outlier. For tens of millions of Americans, that's a wonderful thing. Our unique system, the bedrock of which is the 30-year fixed-rate mortgage, backed or insured by the federal government, has created a dynamic and liquid marketplace with predictable payments and protection from inflation for borrowers. It's made many Americans very wealthy. There are, however, some drawbacks. Innovation is lacking, it creates lock-in effects, and many Americans are stuck renting their whole lives. There are some pretty interesting mortgage products around the world that may be worth looking at in the U.S. Denmark, for example, also has a 30-year fixed-rate mortgage, but the capital market side is very different. In Denmark, each originated loan is covered by a single bond that is sold and traded in the open market. There's no securitization. When a Danish borrower wants to pay off the loan, they can either prepay the outstanding principal amount, just like here in the United States, or they can buy the bond on the European market. When rates go down in Denmark, borrowers capitalized by refinancing. When the rates go up, the prices of the bond goes down below the outstanding principal amount, so they can buy the bond at a discount. It is the antidote to the lock-in effect we have in the U.S., where people with super low mortgage rates won't move because the mortgage is an asset, unquote. So I was incredibly intrigued by this. Here in the United States, we have what is a relatively efficient system when you compare that to other countries. we take for granted the fact that you can just go get a 30-year fixed rate mortgage. In a lot of countries, that's not really an option. And that's because we have a highly functioning primary and secondary mortgage market. So if you were to go get a conventional loan from prime lending or any other lender, that's the primary market. But then that lender is most likely going to package and sell that loan. And that's the securitization process on the secondary mortgage market. You have buyers like Fannie Mae, Freddie Mac that buy up loans and then they package them together into mortgage-backed securities. They sell those bonds on the open market. That's what keeps the money flowing. So the lenders that originate the loans can resell them, make a profit, and then make more loans so that they don't run out of money. And we have stability and liquidity provided in the capital markets because of the backstop, the guarantees, the insurance provided by the federal government and various agencies, FHA, VA, USDA. You got the quasi-government enterprises, Fannie Mae, Freddie Mac. So we've got what is a really good system here relative to a lot of other countries. However, because we have 30-year fixed rate mortgages, when mortgage rates get super low and then go back up, we have this lock-in effect. So we've been experiencing that here the last couple of years, where you've got a lot of people who either purchased or refinanced back in 2021, early 2022, and they've got a 2-point-something% interest rate. Then all of a sudden the market changes, rates go to 7-point-something, and all of a sudden there's fewer transactions happening because sellers don't want to give up that super low rate, because if they go buy something else, they're going to have to pay a much higher interest rate based on those market changes. Now, this system in Denmark is just fascinating to me. So your individual mortgage is not packaged and securitized. It's just trading out there on the open market. And you can actually buy back your own mortgage, which is fascinating. So if you think about it, there's an inverse relationship between prices of bonds and yields of bonds. So if mortgage rates go down, you can refinance. You take out a new loan to pay off the old one. But if mortgage rates go up, what that means is the market value of that bond goes down because of that inverse relationship between prices and yields when it comes to bonds. So in this situation in Denmark, when mortgage rates go up, you can actually pay off your mortgage by basically buying your own mortgage back off the open market below the face value. So I don't know. I just thought that was interesting. I don't know if there's any way for us to replicate something like that here in the United States. I've heard people talk about making mortgages portable, where if you were to sell a house and buy another one, somehow taking that mortgage with you instead of having to pay the old one off and then take out a brand new loan on the new house. Maybe there's some way to do that. But yeah, I thought I would share that with you guys because this just seemed like a really interesting solution. All right, y'all, we're going to wrap up the show today with another segment of Ask Me Anything. This is where you ask questions and I answer them, hence the name. If you want your question answered on the show, you can send an email to hello@realestatebackstage.com. All right, Beth asks, I've never been much of a reader, but I'm looking to change that. What books would you recommend to someone who has been struggling to get their business off the ground? That's a great question. So I'm going to give you maybe a handful of my all-time favorite books. I'll give you some that are going to be applicable if you're like an individual agent by yourself, just a salesperson, whether maybe realtor, loan officer, insurance agent, whatever. And then I'll give you some that would be more applicable maybe if you run a team or a brokerage or a company of some kind. So first, maybe my all-time favorite book is called Extreme Ownership, and that's by Jocko Willink and Leif Babin, a couple former Navy SEALs. Now, the premise of the book is you need to take ownership of everything, all right? Even if it's not your fault, it's your responsibility to take where you are, the cards you were dealt, and improve that situation for yourself and for other people around you. So I tell our real estate agents here at Bluefield all the time that there are things you can control and things that you can't control. Rather than spending time complaining or worrying about or being upset by the things that are outside of our control, like where interest rates are, the terms of the NAR settlement, right? All of those things are outside of our control. Rather than focusing on those things, focus on the things that are in your control. Take ownership of what you can impact and put all of your energy there. All right, the next one is called The One Thing. This is a book by Gary Keller and Jay Papasan. This is a fantastic book. It's all about helping you to focus and doing fewer things well rather than trying to do everything. Really narrow it down. They call it the focusing question. So it's, what is the one thing that I can do that will make everything else easier or unnecessary? So I don't know about you guys, but I tend to have a to-do list of like 5 million things. The principles in this book are all about how to build habits, how to be focused, how to do fewer things better rather than doing 100 things poorly, It's better to do a handful of things or maybe even one thing and execute it on a high level. They talk about the concept of dominoes, right? So maybe there are 10 things that you want to accomplish, but how do you pick which one of those 10 things to do first? And that's the question. What is the one thing that I can do first or next such that by doing it will make everything else easier or unnecessary? So a lot of great principles in that book that have really changed the way that I approach problem solving and habit building and just prioritizing my day. All right, so if you run a team or a brokerage, a couple books by Jim Collins, Good to Great, Built to Last. Those are fantastic. Good to Great is a case study of a whole bunch of companies, I think publicly traded companies, that were good companies, mediocre companies, and then something happened and all of a sudden they became great companies. And typically, that maybe a new CEO gets put into place, and they kind of talk through what are the things that company did to change their trajectory, to break out of mediocrity and go from being a good company to being a great company. And they kind of, dissect, they do case studies and talk about the similarities. Okay, what are some of the common denominators here that all these companies did that helped them go from good to great? So that's a fantastic book. And then a similar book is called Built to Last. These are about companies that really were built to be great from the very beginning. And what do those companies have in common? So Jim Collins is a fantastic business author. I highly recommend those two books, Good to Great and Built to Last. Another good one is The E-Myth by Michael Gerber. This is all about, you've probably heard the phrase, work on your business instead of in your business. So it's all about systematizing, putting processes in place, helping your business to run without you or with less of your involvement, building systems, hiring people, trying to put yourself out of a job. Fantastic book. And the last one I'm going to recommend is called Traction by Gino Wickman. And this is about, you may have heard the phrase EOS, stands for Entrepreneurial Operating System. So Traction is all about how do you build a functioning leadership team within your organization, and how do you structure like your weekly meetings, your quarterly meetings, so that you're actually being efficient, you're getting things done, you're setting goals and making progress towards those goals. That's a really, really good book, so I highly recommend that as well. All right, guys, well, I am going to be out of town the next couple weeks. We're going over to Austin, Texas to visit some family. So I will see you guys in 3 weeks with another behind-the-scenes look at the real estate industry here on Real Estate Backstage.